Hello guys, good evening. So my name is Crypto Kiban. I want to continue the discussion we had in the group this afternoon. And I would like to talk about risk management in this video. We'd like to talk about the risk management, and under this we talk about how to manage risk and tolerance, how to identify take profit and stop loss, how to calculate risk reward, how to calculate position size, which is very important. Advantages of risk management, which is why I denoted by RM here. How losses and wins affect your risk management and your emotional attachments, which is greed and fear. So to begin with, we would like to understand what is risk management. We do talk about managing risk management, and how we apply this in our day-to-day trading activities. So how can we really manage our risk? And I like to say risk management or managing risk is or risk tolerance is individual dependent. Everybody has his own different risk tolerance. I may be able, or I personally, what I can take or what I can afford to lose is not the same thing another person can afford to lose, which is why it's user dependent. But then, on an assumption that if everybody has like $1,000 to play with or to trade with or as your account balance, and okay, say user A and user B has an account balance of $1,000, and then we want to how much each of us can afford to lose. That is our risk, right? If we are taking a trade, assuming we are taking a trade, we want to take a trade on BTC USD. And let's assume that, okay, this is a point of resistance. Let's assume that we want to take a trade at this point whenever the price comes back to it. So how much, and assuming that this is a stop loss, like we have a stop below this low, assuming we have a stop below this low, we want to get in here, which is like the previous resistance, which became supply. Which is supposed to turn to support. I'm not using this as a point of resistance because we have just one candle close above this high, and the next candle just drops back down. Then we have a retest here, then a further drop. That is why I'm using this as our resistance, which we expect to hold as support here. And looking at this move up, here is a bit of small movement, which is like a pause, a market pause, before we have this huge demand coming into the market. And then we are having some like a form of what's it called, rising flag or rising channel there, which we then expect after a while probably to drop back. So let's assume that we want to take a trade at this expected support line, which is 11,930.18, and we are putting a stop just below this low. So let's say our stop is here, which means we are taking a trade here, and here's our expected stop loss. Once the price reaches this point by going below this very low, then we want to exit the market. That is our invalidation price. Here's our entry, here is our stop loss. So if we enter here, where will be the likely points of our take profit? Let's assume we target this highest close now. The highest close so far. So let's assume this is our take profit. So risk tolerance. My risk tolerance will be different from your risk tolerance. Assuming we all have, like I said, assuming we all have a balance of account balance of $1,000 ish. This is our account balance. The amount I will be willing to lose risk in the market in the case of invalidation at this point will be different from the amount you may be willing to risk. Out of this 1,000, I can say, okay, I'm comfortable with losing $100 if I get it wrong on this trade. If this trade goes against me, if I lose $100, I'm okay with that. You may not be okay with that. You may be okay with just losing 50 out of the $1,000 you have. Why someone will be okay with just losing 20? Another person won't even be okay. Another person won't even want to lose any amount at all. So this is why I say managing risk or our risk tolerance is dependent on the individual. Assuming I am risking $100 year to year the market, and let's say we take a loss over 5 trades, which means I take a trade here. Assuming I'm just simulating, like the scenario will be different every time, of course, but just assuming we take a trade with the same risk and the same distance to stop over time, over 5 trades, and we lose. I that is risking $500. I that is risking $100 over 5 trades, we end up losing 500 overall after losing the 5 trades. It's just as an assumption. It doesn't always happen like that, and it does at times. It do. And somebody risking 50 over 5 trades, over time we lose 250, and somebody risking 20 over 5 trades, we end up losing 100 if all the 5 trades goes wrong. Just an assumption, like if we have a losing streak of 5 trades, but then somebody doesn't even want to lose at all, not even a penny, not even $1. So such people, they don't follow the rule of risk management. They just go into the market blindly with an amount of money. Let's say they have $1,000, they can just go into the market with 500, with 100, with 200, with no stop, no invalidation points whatsoever, and they just expect the price to come back up and they take their profits and go off. It does work like that at times, but most times or sometimes it will go against them and they'll be crying very underwater for a very long time. So, which is why risk management is good, and risk tolerance depends on what you can afford to lose. If you have $1,000, you think you can afford to lose $100 per trade. If the trade goes against you, you are okay with losing 100, and your balance, after losing the 100, your balance become 900. You trade again. Some people also do not have a specific amount they choose to lose. They just say, okay, this is my balance. I think I'm okay with losing 1%, risking 1% of that amount. And what is 1% of $1,000? 1% of $1,000 is $10. Some people can wish to risk 10% of their balance. And this is one thing. Some people do get a risk. When we say risk. Some people do get it wrong. Some people believe risk is the amount you put into the trade as your position size. That is not correct. the amount you put as a position size is not the amount you are risking in the trade. The amount you are risking in the trade is the amount that you will, amount of drawdown you will have when you lose or when you exit the trade with a stop loss order. So that is the amount of risk you are taking. So when you risk 10% of your $1,000, 10% is 100. But when you risk 1%, that is $10. Some people can choose to risk 5%, which is $50. Some people can even risk 0.5%, all depending on your, which is $5 per trade. So whenever the trade goes against you, it hits your invalidation prior, you get stopped out on your stop order. It's either you lose like $10, $100, or $5 depending on your risk tolerance. So that is risk tolerance. That is the amount you wish to lose if the trade goes against you. Now moving on to identifying stop loss and take profit. This has to do with a bit of technicality, because there were some days where we see a past resistance turning, we expect to turn to support, and here is our entry. Definitely we take this as our entry, then we target this top as the next resistance point. At the moment we take it as our take profit, but then we just take a maximum amount of drawdown. Like I said, we say, okay, I'm going to take 3% stop loss. Whenever market goes down, gives me 3%, I want to exit the market. But look at this. Look at this. This is 3%, roughly 3%, 3.08%. But look at what is happening here. This was also a point of past resistance, even though it didn't hold as resistance for much longer than this. But it's also a part of where it's a part where the market once stopped and had trouble breaking up. So this can also be a support whenever the price comes back to it. You can just see something like this happening, assuming this is a red candle. You can see something like this happening. Sorry guys, I'm just trying to get, assuming this is a red candle. Oh, I don't know why. Okay. Okay, assuming this is a red candle coming down to the, and we can have something like this happen. I'm trying to set it to the middle of that. Okay, so this is a candle coming down. As the market is coming down, it's this expected line of support, wicks down into this another level of support, then closes above the first level of support. If we have a stop loss here, based on our assumption, like when the market goes against us 3%, we should exit the market. Then we'll be taken out of here. We will get taken out instantly in the case where we have market coming down and then it wicks down into this next level of support, only to close above the first level of support where we actually enter the market, which is also the base of this demand candle. And then we have our next candle, maybe then we have the next candle opening, and we have something like this, and we have something like this. You will be taken out with your 3% strategy of, once it goes against your 3%, you won't sweat in the market. So it is always good to use technical levels when identifying your stop loss and take profit. So in this example, this was why I decided to use here this level as a stop loss, which is just below this very previous low. And looking at this even further back, I can see now here this very high, which was a point of resistance before, and then we have support here. And once the price comes back to it, it can come to this level and find support as well. Can come here, find support, can come here, find support, come back here again, where it was once tested as support, and find support there again. But for the sake of example, we will just take with this level to be a stop loss just under this very low. So our support, this is our entry, this is our stop loss, and that is like a 7.6% stop. That is a very wide stop. But then it won't matter, because if we want to lose $5, $10, $100 from our balance or from our trading account, if that is the amount we can choose, we can tolerate, we can risk, no matter, even if it's 20% from entry to the amount is the same amount, you still end up losing in case the market goes against you. So that is why we have to calculate our take profits and know using technical levels. Now, this is technical level where our stop is, this is our entry, this is a technical level for our take profit. Don't you, as some people too, they do say, okay, I want to enter here, I want to exit the market once it goes, maybe 5% in profit. Oh, you can do that. Profit is profit, that's what we say. But then, because at times in crypto, you can choose to wait for this technical level as your take profit, which is 15% from your entry. Then we have something like this happens. Price actually comes down, then comes up, comes back up, which when it gets there, it gives you some cold feet, then comes back up, then drops. Something like this can happen. It might never get there. That is the point. But that is the technical level where you will want to take your profit. But it's not guaranteed that the price will go there or get there as soon as possible. The price might break this level first before then coming back to test that recent resistance and then come down or break it up. So there is no guarantee. The market, we can only anticipate, and technical analysis is not exact science. It's all probabilities of what will be, what can be, what is likely to be, and the market can just choose to do as it pleases us at times. So now we have our entry, we have our our stop loss, and we have our take profit level. Now let's see how we can choose to calculate risk reward. Okay, so we say year to year we want to lose, let me say I'm risking, let me say my risk is 100, which is 10% of balance. That is the amount I want to lose. I can afford to lose when the market goes against me up to, and touches this level or breaks out. That is my validation point. So once the price reach takes me in here and then comes down here, I lose 100. So that is the amount I'm risking. So what would be my risk reward? Normally, what I do is, you can take this box, since year to year is your risk. That means, oh sorry, that means if you enter one, oh We cannot calculate the position size. If you enter here and you price guess here, you lose $100. If you enter here and price guess here the same amount of move, that means you're in profit of $100, which is 1 hour. Then your 2 hour or 2 to 1 risk reward will be this, and 3, sorry, so wow. Okay guys, so from here to here will be 1 to 1. It's because if you lose 1 here, then here the move from here to here, the same move will be another 1 hour. From here to here will be 2 hour. Then from probably here, the move will pass again, the same amount of move. This will be your 3 to 1 risk reward. This is 1, 2, 3. And if you enter here, it comes here, you lose. Then if it comes 1, 2, 3, that is 3 to 1. And the best way to calculate risk reward is, there is a tool to calculate risk reward. Our take profit here is almost 2 to 1. So let's see, there is a tool to calculate risk reward from TradingView. So this is our entry, this is our stop loss, this is our take profit. So what is the risk reward? Okay, that's 2.01. So as you can see, it's almost the same. The amount of move it takes you to lose this amount, $100, is the same amount of move it will take you to earn the same amount. If it takes double this move in your favor, that is twice your risk. If it's triple this move in your favor, that is twice the risk. If the move up is 5 times this move down, this expected move down, this is okay, 7.5, then 15% will be 2 years, then 15% plus 7.5, which is 22.5, I think, should be around your 3 hour, which means triple this move will give you triple the amount you are expected to lose if it goes against you. It's just as simple as that. So you enter here, it gets here, you lose 100. If you enter here and it goes in your favor up to here, you take 100, that's $100 in profit. If it comes here, $200 in profit. If it goes here, $300 in profit. Like that. If it takes another of this move up again, up to 5 hours, you just keep making the money. So how do we calculate our position size to exactly get to lose this amount if we enter here and then the moves comes here? Because some people now, they will enter here with the whole of their balance, 1,000, and when it goes against them, 7.5, I think, that's 7.5, that's 75. So no, what am I saying? Okay, let's calculate position size. So how do you calculate your position size? I know how much I want to lose if this move goes against me. Then what is the distance from entry to the stop? Let me use this two. This is entry, this is my stop. The entry is 11, 330, 18, 11, 330.18, and the stop is 11, 11,027.31. Okay, that's 7.57%. So to calculate our position size, the amount we want to buy in here, then it has to be this risk, which is 100. The risk amount we are risking, which is 100 divided by 7.57%. 7.57%, that is 0.0757. Then we have 100 divided by 0.57. I mean 757, yeah. So we have our position size will be 1,321. 1,321. But then the thing is, our balance is just 1,000. So if we choose to risk 100 over this huge distance, then we have to trade the position size of 1,321, which means we have to use leverage, right? There is a tool, an SF5, which I have created to calculate position sizing, and here we haven't even implied any leverage yet. And okay, here is it too. So let me just put this as tests. Okay, so we assume we have a balance of 1,000. Leverage is 1, since we are not using leverage at all. We have a balance of 1,000. We are risking 10%. Distance to stop is 7.57. Distance to take profit is 15%. So here now we have our risk amount is 100, which is the amount I've stated I wanted to lose, which is 10% of 1,000. Then our position size is 1,321. We are using no leverage, which is like spot market. This simply means we cannot trade above our balance. This simply means we have to reduce the amount we are risking in this situation. The R as calculated is 1.9. This is more than 15%, but I've just decided to use 15%. It's 2 point something anyways. So sorry, I'm trying to figure out where. Okay, so we cannot trade above our balance except we use leverage and margin borrowing, but we do not want to do that at this moment. So what we do is we basically reduce our risk. So let me say I'm reducing the risk to 5%, which means I'm basically comfortable with losing $50 out of the 1,000 balance if I get invalidated. This is because our stop distance to stop is very huge. So now I'm losing $50, I'm risking $50, and our position size is 660. Let me just get the exact distance here. That's 1131.8. Then 13,783.73. That's 15.54. Okay, 10.54. Okay, that's 2.05 risk reward, which means if we take this trade here, it doesn't go against us, we do not lose, and then it comes straight here and we take profit, we are going to end up with a profit of $102.5, which is even more than double the amount we are risking, because this risk reward is more than 2. It's simply we are risking $50, and the move is double the distance of our stop, which means the amount we are risking times 2, which is 100. If our R is maybe 2.5, then this goes above 100 to maybe 150 or 120. So that is how to calculate your position size. The amount of risk you are taking, divide it by the distance from your entry to where you have your stop. That is how you calculate your position size. Here we are risking $50, which is 5% of our entire balance, and then our position size becomes, this is converted 100 divided 7.57 divided by 100, that's 0.0757, 60.5. Then this is the amount of profit if we take double this move. Assuming this trace comes here, it fills our order, then it comes up 7.5. This exact same move from here to here. From at this point, we are only making $100. We are only making $100. When it gets here, we make 200. When it goes from here again, an extra 7.something%, then we make 300. That is 3 to 1. I hope you guys understand. Okay, let us assume we have a balance of 1,000 here. We are using a 10x leverage. We are risking the same 5% of our balance. We have 7.57 to stop. Then we have 15.5 for take profit. You see, the risk amount is the same. We are risking 50. Either you are on spot market risking 50 to stop plus the same amount of distance to the stop, or you are in futures market risking the same amount of $50 to stop on the same distance, the same scenario, the same amount, the same take profit, the same stop loss, the same entry price. Either you are using 10s or 100s, or you are using 1s on the spot market. You have the same amount of risk, you have the same position size. The only difference in is initial margin. In spot market, there is no initial margin, it's just the size. But here in the futures market, you have 66.05 as your initial margin, which is your money that you place to take a loan of $600. That is your initial margin. The risk reward is the same. Here, the end profit is not the same, because here the move is from entry to take profit is 15.54. But on futures, you multiply this 15.54 by the amount of leverage you have, which is 10, which is why we have 155.4. That's we on Binance, it will show you like ROI, return on investment, in percentage. But the end profit amount is the same amount of 102.5, 102.5. So no difference. No difference at all. Okay, now to the advantages of using risk management. So what can we say is the main advantage of using risk management? To me, it has a lot of advantage, but then technically looking at it with our previous example, where we have a balance of 1,000 and we are risking, our risk is $50, which is 5% of our entire balance. So let's say we take a trade-off. Let's say we take 5 trades. Let's say we take 5 trades, out of which the first 3 we record loss on the first 3 and 2 wins, 3 losses and 2 wins. This means, assuming we use the same risk in all of these trades, not going with percentage of account balance, because if we take the first trade and we lose 50, if we take the first trade and we lose 50, let's say first trade, which is a loss, minus 50, balance minus 50, our balance becomes 950. Then second trade, which is also a loss, minus another 50, assuming we keep our risk the same. Because if we want to use 5% of 950, that means it's not 50, it's maybe 40 something dollars, which means the risk is reducing. We keep using a certain percentage amount of our balance. But if we keep the risk the same, as like we are okay, 50, no more, no less, no matter the account balance, I want to raise 50. Then on the second trade that we lose, that will be 950 minus, then our balance becomes 900. And on the third trade, which is also the losing trade, we lose 50 again, keeping risk the same, then our balance becomes 850. This simply means the first trade we take from year to year, drawdown, we lose $50. We take the second trade again with the same amount of risk, $50. It goes against us again, we lose another $50. We take the third trade, hoping to get better, but see, it comes against us, then we lose another $50. Now, let's assume that the fourth trade is a winning trade, where we have 3 losses, 2 wins. The fourth trade is a winning trade, and using the same amount of risk. Here is the cash. If some people, if you are patient enough to wait for your target, and assuming the price comes down to your entry, then rallies up to your take profit, this is like 2R, right? So on a 2R, 2 to 1 risk reward, here when you win this trade, you are winning 2R, which is plus 100, which is 2 times your risk. 50 plus 50, that is 100. So your account balance of 850 plus 100 that you just won will give you 950. And the fifth trade, which is also a win, assuming the same scenario, the same risk reward, 2R. I mean, when I say 2R, I mean 2 to 1 risk reward to risk ratio, or 1 to 2 risk reward ratio. Here again, you win plus 100 to the 950. So your balance becomes 1050, right? Am I correct? Yes, 1050. 50, which means you started with a balance of 1,000. You lost 3 trades consecutively. Your balance came to 850. Then you need just 2 trades to overturn this deficit of 150. Because when you sum it up, first trade you lost 50, 50, 50. That's a deficit of 150. You need just 2 trades, and in these 2 trades, you made 200. Which means when you calculate your profit and loss, that will be 200 profit minus $100 down, 150 down, which means overall you're in a profit of $50. So overall you're in a profit of $50. But this is just for 2 to 1 reward risk ratio. If you go with 1 to 1, that is why 1 to 1 is not advisable. 1 to 1, if you have a drop down of 150, here when you win 1 to 1, you are winning 50. So your total win on a 1 to 1 risk reward is 100 on both winning trades, whereas you are losing 50. So you have been able to at least recover some of your lost money, but then you will still be in a loss of $50 if you use 1 to 1. Over 5 trades, you lost 3 trades and win 2, which is why the higher the risk reward or the reward to risk, the better. And people do advise you should go for a minimum of 3 to 1 risk reward. It's achievable, but then you just have to see what works for you. 2 hours is good, 3 hours is okay. Assuming you are trading with 3 to 1 risk reward, here instead of taking a profit of 100, you'll be taking a profit of 150. 3 risk, that means triple the amount of risk here. 1, 2, 3. That means your take profit will be somewhere up here and not here. And then if the price comes into it, here you'll be taking a 150. Here you'll be taking another profit of 150 on a 3 to 1 reward to risk ratio, not 2 to 1 as we have in this example. So here, if you take a profit of 150 from 850 here, this will be back to 1,000, I think. Yes, 950 plus 50, that's 1,000. So you have 1,000 here. That means you've lost 3 trades, but then you win 1 and you have recovered all your losses already. Then on the next trade, you win 150, then here you become 1,150 on a 3 to 1 setup. Then you have a drawdown of 150, you have a profit of 300 overall, and 300 minus 150, 300 minus 150 is 150. So you have a total profit of 150. Assuming your risk to reward is 5R, which is 5 to 1 reward to risk ratio. This means you'll be taking 50 times 5 if the market goes in your favor. If it goes against you, you lose 50. If it goes in your favor on a 5-hour setup and it is your 5-hour target, then you are taking 50 multiplied by 5. That is 250. Oh, am I correct? 50 multiplied by 5 is 250. Yeah, 250. So if you take 250 here, if you take 250 on a 5-hour setup, 250 here, that's 850 plus 50. That's 850 plus 50. That's how much will it be? 1, I think. That's 850, 59. That's, yes, 1. Then on the last trade, 1 plus 250. That's 1,350. So overall, you have a drawdown of 150 over 3 trades and a profit of 500 over 2 trades on a 5-hour setup over 2 trades. That will then give you 500 minus 150, which means you have 350 overall profit on a 5-hour setup. But this setup we have used, for example, is a 2-hour setup, which means you make double the amount you risk to lose. So that is the advantages of using risk reward and risk management in short. Then there's another thing, the last one I want to talk about, emotional attachments, greed and fear. This is a problem with majority of us traders because, okay, let me give another scenario to explain this. Assuming sometimes the market can do us very good by going in our favor. So assuming our risk is the same, assuming we have 5 trades and we have 5 wins. We have 5 wins from 5 trades. That's 5 in 5. What do you think will happen? People will get ecstatic. People will be happy. Oh yes, I'm good. I'm a guru. The market is really going well. We start developing courage. It builds our courage. It gives us morale high. Then we start believing ourselves that, and if it happens in this form, say the market drops from here into the middle of your buy zone, they didn't even attempt to come close to your stop loss, then shoots up. Even if it's like this, then shoots up. It doesn't get anywhere close to the stop loss. And it happens on those 5 trades like this. None at all came close to the stop loss. You will see, you'll be confident that, oh, my strategy is very good. I don't have to use stops anymore because you won't want to lose. So it gives you a kind of confidence in yourself that, oh, over 5 trades, none of them even stopped, none of them even came close. Just maybe the one that even went deep inside just came half of this buy zone, then went back into profit. So it gives a confidence, and we want to make more. Everybody wants to make more money. You that you're trading with 660 and making maybe $100 over 15%. What if you put your entire balance here? You put your entire balance here and you make 15% here. 15% of $1,000. You know how much that is? That's 150. That's 150. Whereas you have the same risk you are taking on these 2 trades, you are taking just 100, whereas you can be taking 150. And if you have, the more money you put, the more money you make. So people get overconfident, and then the desire to make more money as the market is going their way starts creeping in. Some people too do not get greedy due to overconfidence, but due to pressure. Maybe, okay, the month is ending, you want to pay this bill, you want to pay that bill. You have some pressure on you to do something. You want to buy food, you want to pay electricity bill, you want to fuel your cars. So you need money. And then maybe the amount you need is, you have just $1,000, but then you need $200. And maybe the amount you'll be making, since you have been really conservative, because not everyone will risk $50, some will risk 10. And so if it goes in their favor, that's $20. Then you need 200. You'll be taking 2 hours trades, taking $40, $40, and you need 200. You will feel pressure to add more money and do more. So you get greedy And most especially when you've seen that all the trades you've taken keeps going in your favor, none has gone against you. So you get greedy. And the moment you get greedy, that is the moment when the market will start going against you. Then the fear comes in. You don't want to lose. You have put your entire balance because from your past 5 or 10 experiences, the market just come from up into the middle of the zone, then goes back into profit. Then you expect the same move to happen, and you'll be trading maybe $100 your entry, depending on your risk amount, or as per this, maybe 660, which is not bad by any means. Then the desire to make more, you go take some loan because you have the confidence that your setup is very good. Then you put in all your balance. You went only $1,000, bam, expecting the market to do this. But then the market comes, and then this happens. And then the market comes down, comes into it, comes a bit up, then drop. And you haven't used any stop because you have the confidence that, oh, your setup is always right. The market doesn't even go near your stop, so there is no need using it. Then the market does this. Then it comes back again. You have hope that, oh yeah, it's coming back, so it's going to continue going up. Then it comes back further. Then you have no stop. And the moment the market gets here, you are already losing like $75 instead of the $50 you could have lost. Then change your bias depending on the structure of the market. But then you are all in, the market comes down, it comes a bit up, but because it's coming up, you think, oh yeah, it's going to do like this. Then it comes to this point of last support, uses that resistance, then goes back down. Then you are deep spiraling into losses. And then you are also still scared of selling because maybe the moment you sell at this point, you end up selling at this point. You sell finally at this point that, okay, the market has finally done you grasp goes. Then you sell. And the moment you sell is the moment when the market chooses to reverse. And the moment you see a previous high leading to a lower low gets broken, there's tendency of the market reversing. Then you start crying. You have lost a lot of money. Probably you have lost even half of your portfolio or 20% of your portfolio, which you could have avoided by just sticking to your risk management. So that is a little thing I could come up with today. It's not a professional video by any means. I also have sore throat, so I cannot speak so much loud. My throat is so scratchy, but yeah, I just have to manage and put this video up so we can at least something to watch and discuss about. If there are any other questions, I will be entertaining and welcoming to talk about them. If there are some things I've missed, I'm not a professional by any means, even though I've been trading for like 4 years now. But still, we learn every day. We learn from each other. So that is a little thing we could talk about now about risk management. The emotional attachments are a way lot more than what I can just wrap up in this video because it's taking a long time, which I didn't anticipate. But then I hope you find this little video very useful and consider using risk reward depending on based on your risk tolerance levels. If you have a balance of 10,000, if you ask a balance of 10,000, you have a balance of $10,000, and then you are using risk or $50, you know you are over trading. I mean, you're under trading. This is also as a result of fear of losing. You have 10,000, you do not want to risk a decent amount. You know, the higher the risk, the higher the profit. So just look for a way around. Okay, maybe you risk 1% of 10,000. You don't want to risk much. Risking 10%, maybe $1,000. Then you just say, okay, you want to risk 1% of $10,000 because as your balance grows bigger, then that is where you find it difficult. Maybe you are looking at an amount, you have $10,000, you are looking at, oh, you want to risk $1,000, which is 10% of the amount you have as a balance. Then you are looking at, oh, somebody is even making $1,000 a month. So you're looking at if that goes against you, or are you going to lose somebody's salary for the month in just one trade? So you just have to find the balance. So if you risk 1%, that is 100. Not bad. But if you use 3-to-1 reward to risk ratio, when the market goes in your favor and your take profit target, then that's 300. Then grid resetting again, because when you take 300 from a trade with a balance of 10K, you are looking at it like, oh, you are doing nothing, you're making money. Then grease start to come in. Either you stop using stop loss, then you start trading with blind trading. Just, oh, okay, you have this entry, then you put in $3,000 or 50% of your balance, $5,000. It goes against you, it goes in your favor, you make good money. But then when it comes against you, you also lose good money. So you just have to find a compromise for what you can afford to lose. And when you lose that amount, no, you have lost a small amount that you can afford to lose. That is why they say never trade with what, or never invest what you cannot afford to lose. And when it goes in your favor, 2R, 3R, at least you are making something. Small drop over time makes a mighty ocean, they say. Do not get greedy. Do not get fearful. If you experience a losing streak, take some time off, reassess your strategy. If you think you are using a tight stop, or you are using stop loss in a very bad position, because that happens too. But that is another topic for another day. Stop placements. Like I initially specified, that if you place stop here, some people will use 3%. Say, okay, when I first started, I did that from entry 3%. If I go 3% against me, I want to exit the market. But then you are exiting the market at where people are buying. Even here, some people are also buying here because they see this as a point of previous resistance to support, even here. So majority of this run up to this side are buy zone. But stop placement is not a topic for today. That is another topic on its own. And hopefully soon we shall discuss about that. I hope you hear this video, and I hope you find it useful. And any question you have, or any suggestion of any topic we can discuss, you can kindly let me know so we can go over it. Have fun and have a blessed night. Thank you.